Well, thank everybody for having me, and there's been a pretty good group of different facets of the emerging manager opportunity within the context of what's going on with the institutions and emerging managers, and we are one. Although I've done this, I started in the business in 1987, so I'm definitely an old hand at working through the system in various facets. I was a financial advisor at Morgan Stanley and UBS in the day, starting at Bain Weber, believe it or not, in an old name. And then, but I've been on the institutional emerging tech side for about 25 years. And I was a sell side analyst for about 6 years. I was an investment banker serving that field up in San Francisco for about 8 years. I ran my own investment bank, and I've run a hedge fund in the same emerging tech domain for a few years, tied in with the investment bank. I was the analyst and hedge fund manager in that effort. So now I run a fund called Helios Alpha. And the subject today that I tried to bring about was we've been having pretty successful years in the last 2 or 3, which has not been easy in tech, right? It's been really, if you look at maybe like the ARC Innovation Funds, which is a good bellwether to somebody who has the new mantra, buy anything at any price if as long as it's growing, right? That has been a tough way to go, and it has really netted a downdraft of 50 or 60%. Almost matching perfectly the dot-com bubble unwind, right? It's been a year and a half of that. And so, with interest rates rising, war, inflation, you would look at this and say, well, we're just beginning a bucket of trouble. But in the tech world, the prices have rationalized for almost a year and a half, and we're probably about 3 to 6 months off of a bottom. But that's still a tough bottom and a tough 3 to 6 months ahead. So, how can you make some money and maintain your kind of green and ESG commitment, right? Because that's obviously a big mandate for our fund. It's a big mandate for a lot of allocators, but nobody likes to allocate and lose capital, right? So with that said, we thought we'd review some of the things we've been doing to kind of maintain some upside and some strong upside, and yet at the same time kind of mitigate the downside, because obviously picking the bottom is more than tough and generally not an expertise of anybody, or picking the exact top. So with that said, that's really what our fund specializes in today, because as you've heard from many of the other speakers, you really do need some special tools as a fund to produce value for your allocators and for your LPs. And if you don't have those types of special tools, and somebody like a BlackRock can do it, they're going to go do it at scale with BlackRock's margin structure, and they won't be doing it in a hedge fund structure, right? So we do have some of those unique tools, and we have a small enough target pool in the hundreds of millions to keep it where it's not going to have a BlackRock coming in, or Morgan Stanley, or somebody that really of massive scale with massive ETF-like margins, right? So the best way to do, or at least I felt to kind of present what we do, is give you a real-time example of something we're funding right now, and that is a company called Mphase. It's a really unique situation, and I'll show you the tools that have led us to have an up year of 65% last year. Wow. To believe that we can have another up year in a really tough tape with tools and investments like this. So generally, as you look at Greentech, what are some of the things that a common hedge fund would do? Generally, they're going to be doing an allocation like Warren Buffett, and like most, at least as some of our other speakers, you're going to find, well, I'm going to try to buy low and sell high and maybe buy through a trough. So that's certainly one thing that I think some smart money and some money flows are beginning to pushing back into some of these tech names already, and they're thinking about winding out of some of the things that are peaking. And I don't mean an exact top, but like oil, right, at 107, it's not going to go to 214, right? And say a lot of China and a lot of tech, they're at not just 52-week lows, but they're back to 5-year lows. right? So, I mean, that's obviously nibbling through that bottom is kind of what, as a GARP strategy manager and a Warren Buffett, Graham Dodd type of guy, that's where we begin in our pool. Where do we start fishing? And then obviously going long short is something else that is a common hedge fund tool. And of course, like everybody else in the hedge fund world, we were short the ARC funds actually. As they went through the roof, it was just killed you, and they went further and it killed you more, and we had to kind of add more. But we lived through that and lived through the meme stocks, and now we're kind of actually covered that short, and we're beginning to nibble on the long. But there's still some bubble out there. I mean, I'll give you something we wrote about in our last newsletter. There's companies like the car companies, right? Rivian, Lucid. They're trading on $40 billion of thin air and no sales, right? I mean, so you got to look at NIO on the other side at 1x enterprise value to sales in China with outstanding growth and profit, and just ask yourself, okay, I'm going to maybe pick up a little NIO and put that short on, and at least arbitrage them coming together at some time. There are outliers like Tesla. I have to say they're just amazing, the level of innovation there. And as an innovation fund, we have to really appreciate Elon taking almost everything to the next level and never stopping, from cars to robots. And that's, I think, the premium there. But regardless, just playing car company to car company, 40 billion on thin air versus 1x enterprise value to sales, I'll take that all day long. So that those are some things we do in the broader portfolio, but in the context of special things that we bring about, that I'd say they were okay to buy through the trough, pretty good to do your ARB, Rivian versus 1x sale of NIO. But what's better and what's best, right? What are we doing better and best? And so in the better and best, and this is really what gives us our biggest alpha, we can do pretty well with the other tools, is to really find things that are off the grid. And I appreciate the other manager who said, find things where the crowd is not there yet and bring it to the crowd, right? So that is a absolute methodology in which you can certainly find things off the grid in the small cap, micro cap world, and say, is this asset going to scale institutionally in the next 12 to 18 months? Is it in a good sector where the macro is going to be growing, whether it's like healthcare services, which are certainly healthy, or EV, something that is with oil up, that's actually getting a little pull. And can they get structurally sound? Can they get them up to NASDAQ, right? And that's a big plus for any company. So once you get up to NASDAQ and you're 250 million in cap, you're right at the beginning of the hedge fund journey, and you're right at the beginning of the index fund journey. And there's a lot of money in those index funds. So there's your crowd, right? So that's certainly what we look for. And our last two investments have been, and I want to go into more specifics, have been in healthcare services, a cardiac monitoring company called Biotricity that went and made that transition from kind of microcap OTC bulletin board up to NASDAQ, got fully funded, and now they're taking their data set or database of 3 million patients, and they're flowing monthly care services to them. So they're a great example. They were the best performing healthcare tech stock, or I'd say top 5 healthcare stock last year. That was a big part of our return. And but more specifically, in the now time, we entered them through a convert, and obviously the converts offer that asymmetrical protection that you might be looking for if the market's still a little squirrely. And as we sit here today, you're not really sure is it at the bottom. You just know you're kind of getting close. Well, in the convert architecture that we use, and which is common in a pipe fund like ours, you can get obviously first lien protection on all assets, like a senior secured piece of debt, and that's exactly what we offer. And you're going to collect your interest. Usually, it has an OID. The yield on that is usually about 20%, right? And this is just on the debt side. So we had a company that was called Mphase, which is now a tiny $10 million market cap company. But with the convert architecture, we actually made money as the stock went from 20, 30 million cap down to 10 as times got a little tougher. And that's what we're looking for, is to produce the asset. And underlying the company made massive progress operationally. They had already $30 million in sales, and they were profitable, which is not normal for an EV company per se in charging. Most of their peers are losing a lot of money, like ChargePoint you see all the time in the office buildings, Blink, Beam, and so on. But these guys were making money because they came at the target market a little bit differently. They came out as a tech company with a retail ad network that they then overlaid onto their chargers. So they could use the traditional AI tools to match a profile to your real-time charging. So when you go down the street, they always put you at a charger that works for you when you need it. And they have the things that you like there optimized to your profile. So there's a big cash flow on the advertising side. And I'll give you some scope and scale of that. But the bottom line is that match makes a much happier business because you're driving foot traffic to the business. It makes a much happier green consumer because they're not sitting at a Tesla charger where they can't go to the bathroom or get a cup of coffee, right? And that's the basic premise of this business. And they launched their platform in December. They signed up 3,000, roughly 400 retailers in the first quarter, and they'll capture about 15% of them with chargers. They'll cherry pick the best ones. So there's a profitable company that we put a convert against, and they're just about to ramp. But the more exciting thing for us is, of course, we're value GARP investors. So usually this field trades at about, well, the peer group currently trades, even after they've come down materially, at 20 times to 130 times enterprise value to sales. So that's the math. This company trades at 0.3. So you guys can get the math, right? It's 10x to 3, and of course to 30, that's 100x. So the equity potential upside in this equation is probably the best I've seen in terms of taking something that's way off the grid, but it actually because it's repositioned the EV space, a pretty good value proposition, is profitable, and will end up being one of the faster, if not the fastest growing EV companies for charging. Kind of they'll go from 0 to 5 million in their first year, which is usually not the flits, like 0 to 1 to 3. It's a slow start because the physical chargers are a little bit slow and they're linear. They can exponentially ramp in their retail network first with the revenue associated with it, and then pull the prime charging spots through. And this usually, obviously, superior profit, superior growth drives superior enterprise value to sales multiple or price earnings ratio multiple. In this case, you have a discount of almost 1/100th of the peer group. So in addition to having and coming in through a convertible debenture with the warrants to give you upside, that we are converted at a 100% warrant or upside, it had 5% yield, and it had 20% or 15% OID. So we had a 20% base return, and we'll see what the warrants can be worth. Basically, this one had enormous equity potential upside, and they were already, without doing anything or raising any capital, approved to uplist to NASDAQ. So here was usually you have to do a lot of work behind the scenes, and you have to let them grow a little bit, and you have to clean this and move that. In this case, they were already had the equity ratios to meet the NASDAQ requirements. And so that's where we went out and got their first batch of research. It was from Zacks, which is kind of just an institutional research name for these small caps. We retained H.C. Wainwright, which I don't know if you're familiar with them, but they're a bank that does a lot of emerging growth. They do a lot of crypto, and basically, but they do hundreds and hundreds of billions of dollars of banking deals. They're a material bank. But they saw the story and did the math themselves, and they just, jaw dropped. And they said, yes, we'll take that, even though it's a $10 million market cap company, to uplist to NASDAQ. And so the equity upside here is material, different than I've generally seen. For example, Biotricity, which was in the healthcare space, the prior company, which was a really good performer. Basically, they were at 20 times EV to sales, kind of in line with the other peer group growers. So 0.3 is definitely materially different. And offers a dynamic of which we look for and say, wow, if this thing gets up to NASDAQ, actually begins to reasonably execute, which it's kind of already doing on the retail side. They have, I think, 2,000 people on their platform now. They've won about 3,400. and then they have their chargers in-house, which they're now deploying this quarter. They'll connect the dots, and we'll see some type of appreciation even in a terrible tape, right? So that's kind of, that's our I'll switch it to Q&A, and that's kind of our mission, is to produce that asymmetrical risk reward and try to be sensitive to valuation, which was at a pretty heavy peak. Now it's come down pretty nicely, where in the tech we can really begin to go long again, but we're still using all the tools in the toolkit to really give that downside protection. And if we can go off grid and find something like this and bring it right into the mainstream very quickly, we think there's a lot of potential upside now. Hopefully in a tape that's not as tough as everybody thinks, because we could all use a breather. Right. Yes.
Sure. So Chet, you started off by saying you kind of seen the tech wreck happen, the price rationalization over the last period of time, and you kind of value, because they're a value GARP guy in
Right.
emerging tech, which is interesting. Could you give us a sense of the size, the positioning, the mix of companies that you're looking at in your portfolio, or how does this figure into the way you do business?
Sure. So in terms of the construct of the portfolio, what we do is we run a general pool, like a classic long short fund, right? So we'll have 50 longs, 50 shorts, or depending on the ratio we mix up. It's a pretty diversified approach, and that's a pretty healthy thing for us, because it keeps you very in tune with the EV space to own or be short some of the EV peers, right? And so that in our fund ebbs and tides between 2/3 of the fund to even just a quarter of the fund. But usually we keep a pool in that long short structure, and then we're hunting for those special ideas that we build concentrated positions in, and usually it's always capped at 20% max, but we're really trying to get somewhere between 5 and 10 in these more exciting ideas that we take in as a convert, and we say, wow, this one we can move right up to the institutional marketplace, like a biotricity, and we can start with a convert until it's really stronger, and then come over to the equity side. So it's something like that. So in a dream scenario, we carry that mix of 4 or 5 big ideas, and then diversified portfolio, which also we do quite well with as well.
Do you have a flavor, a sense of more shade to healthcare versus tech versus other kind of growing, growthier fallen angels, so to speak?
Yeah, I mean, basically we try to be really opportunistic. With that said, because right now it's for example, when COVID, healthcare got out of hand. It just got peaked out and priced out, and then for the last a year and a half, it's actually come and unwound materially. Biotricity didn't as much because they were growing so strongly, but we try to kind of be GARP aware, value aware, and when Green went through the Biden transition with all the money flowing and the ARC funds went through the roof, you saw it. We actually went from long to short, and so the fabric of everything we do, whether it's in a conservative convert and or out in the open market long short, it's always a GARP mission. Right. So that
mix of investors, private equity, I'm sorry, endowments, foundations, family offices, what's the mix of investors?
So actually, my mix is really, it's family office right now, and actually I manage some money for some money managers who manage big funds, and they look at what I do and they're like, oh yes, Chet, well that's, they're running multi-billion-dollar funds in big mutual funds. Like I'd like some of that down there, and they know the sectors too, and they appreciate fundamentally what I do. They're owning that in different ways, right? So that's my kind of current mix.
What's the typical market cap you look at?
So generally we keep ourselves unbound by cap, right? And we're going to find more alpha in the smaller cap domains, and obviously the off the grid to on the grid is the beginning of small cap / micro cap that gets that $250 million. So you'll find the core positions, they kind of are in that genre. But if if a big company is really cheap and is in the right sector. And I'll go back to, we had one of our speakers talk about energy. So what's opportunistic in energy right now? And well, you're right. How do you fill the gap between wind and solar? And you can look at nuclear. It's a little bit dicey in terms of, questions. But I mean, we bought some Rolls Royce based on that because they have a big nuclear effort. And so there's some little companies doing uranium mining up in Toronto too, but also, we will look at Albemarle doing lithium too, because we want to keep the wind at our back. And if it's the beginning of a cycle, you can still do quite well, and we do quite well.
Any geothermal, stuff like that?
Yeah, exactly. So if it's a little bit bigger in the general pool, we'll allocate to that based on kind of a classic DARP. And if we'll go short it too, if it's big, in that sense.
Is the sphere that you look at primarily like almost like in the value space, where like these are like firms that are not covered by your general Wall Street?
Well, you find that like so we're more
general.
thematic about growth. So generally we're doing fintech, Greentech, medtech, right? And we're looking for innovation, but we're trying not to do the ARC approach and pay it at any price. We're trying to buy it at a great price, right? And so you find that generally as things go out of favor, right? With the big companies, they get up and they get down, right? The world could implode and crypto would be clobbered, and we'd say, oh, well, we should probably start more in crypto now, right? But at peak prices, we're, neutral or net seller. But in the bigger positions, we definitely try to go off-grid, sub-institutional, and come in them really conservatively and scale them up. And we specifically need innovation and the wind at their back, like a good venture story. You must have interest to carry you through tough times and missteps.
What's the average time of your hold, like duration of holding a stock?
Usually it's about 18 to 24 months. It's a time where even in the say sub-institutional to the institutional journey, we want to make sure we can have that fully up to NASDAQ, the business model fully ramping, and a lot of people just giving them, other than us, growth capital.
Do you find that the explosion of companies that went public the last 5 years is kind of like, I don't know, created kind of like a soup that you have to kind of like, I don't know, scoop out and figure out what's there? Because I mean, obviously there's a lot of SPACs that came out, there's all these SPACs are now underwater, a lot of reverse mergers, there's all kinds of people went public in Canada, or
well, I mean, they have, so we're as a fund and as a fundamental analyst and portfolio manager and banker for that degree, the SPACs to us were hyper unappealing, right? And I get back down to brass tacks of just, cash flow, earnings, enterprise value to sale in the realm of reality.
Yeah.
So, but I'm seeing a lot of tech that was at 20 times or zero revenue at 40 billion, that's still hanging out there. But I'm seeing a lot of tech that's growing really well, that it says strong value proposition in classic enterprise tech at 5 to 10 times, in line with Microsoft. But they're growing a lot faster than Microsoft and Google, right? So we're back there in tech and Greentech too, right, to some degree. And so I think that piece, the markets has hung on these mega FANG, or then they call the chip. What's the chip new name? If somebody can throw it to me. Yeah. It's like some flower name, but regardless, AMD and NVIDIA has a new acronym. I think that they've hung the market up pretty high and strong, and the bigger cap. But in the innovation field, the rationalization has been very large. And I think that those, not that they won't get clipped if there's a big pullback, there's a bit more to go. So we're still, trying to keep that convert approach and that long short, we're net neutral right now. But you are seeing things like Microsoft at 5 times enterprise value sales, but I'm growing 10 times faster than Microsoft right now, and in some good companies. So I'd say it's getting to be time where you can buy tech again. And we just made our first nibble on China because of the Neo comp versus Rivian and Lucid, right? That was just too much to not look at.
So speaking of Rivian, any thoughts on their announcement? There's going to be a shortage of lithium for batteries until
I had a clear thought.
2030?
So we've been long lithium for a long time. And I can tell you what's going to happen to a car company when there's a shortage and they can't get batteries and they cut their already unrealistic pricing, and forecast.
Right.
It's going to vaporize Rivian.
Right, so the big question for green energy is this whole thing of affordability, right?
Right.
Because all the,
accessibility of their material sources, the lithium and everything.
Right.
Right,
Like
and
a
you're
chip
coming up with,
shortage of.
In Africa and so on.
you're an engineer also, right? So I mean, that's, the reality, we had Incotel come in here and speak 10 years ago, and they were like investing big into windmills in Texas. And they were saying, well, we're just using it for processing because you really can't store the energy anywhere.
Right.
They've become successful in Texas, said, and they probably have 2 or 3 times more windmill electricity than anybody else in the country, right?
Yeah, and I think they say now that 85% of the new solar and wind deployments have the backup storage. So the pressure on lithium is enormous.
Right, right.
And the
Yeah.
potential for that
The challenge with the
shortage.
backup storage, I used to work at Continental for 10 years.
Right.
The challenge with the backup storage is how long can it store for?
Right.
If it's 6 hours, 8 hours, the longer you get it. Lithium they're always advancing technology. It's just
Right.
We need it for like 24 hours, need it for weekdays, not weekends.
Right. And there's the
I think the big issue at the base level, right? Being able to, we were in Austin, there was a big discussion about just being able to maintain this base level of energy they just need.
And that's why I was surprised there's so much discussion on nuclear power plants because they provide the base. But the gas turbines and other geothermal, not too much. Wind, you depend on the wind. So a lot of excitement about it. But the base load that the nuclear, the coal, the oil, that's what they provide the base load, which is so critical.
Right.
We don't have lights.
And there's a crisis in hydropower right now because of all of the droughts,
Right.
and just like all the rest of the infrastructure in the US,
Right.
it hasn't been supported, right?
Yeah, a lot of environmental issues. Too.
Yeah. So with that all said, I think the green story is at a more reasonable price, and the demand with oil up and all these dynamics are really offering a nice pull for that opportunity. And so we're quite excited about M-Phase, which I know is not so exciting, but I'll leave you with one thought for our crypto friends. I'd love to hear you opine on this. So along with M-Phase deployment for their green consumer, what they did was they put out a green token for credit every time somebody charges at a consumer level, and every business who loads up with 4 to 8 or 12 chargers. An emerging token said what smart contract could be compelling in the token world? And of course, there are going to be so many, both from real estate to the obvious ones like art and royalty. But I would also put the carbon credit market back as one that we think could be really compelling. And this is what comes with the kind of the M-Phase green consumer application, is that everybody gets a token account. So when they pull a charge, or they have a small medium business puts the charger out, they get that carbon credit. And so, of course, today the carbon credit market is very big institutions. Amazon's the biggest buyer of carbon credits. Fractionalizing it is the beauty of blockchain, and automating it is the beauty of blockchain, because you can fractionalize both real estate and compelling carbon credits down to the consumer and small business level. So I'll leave you with that this is what we find exciting about innovation, but at a price. So I have to say, I can't agree more. Growth at any price is not proven to be a very good idea, but growth at a price is, our philosophy.